There's certain investment terminology that you're going to see in your 401k statements, your IRA statements, brokerage statements, terminology that's constantly used in financial articles, or that you're going to hear when speaking with a financial advisor or listening to the financial media, but you actually have a clear understanding of what these financial terms mean. And today, we're going to talk about the investment terms that you should know, what they mean, and why they're important to you and your financial future.
Welcome to the Your Life, Your Money podcast with Scott Searins, teaching you how to thrive in life, wealth, and retirement.
Welcome to the Your Life, Your Money podcast, where we discuss thoughts, strategies, and actions to help you thrive in life, wealth, and retirement. I'm your host, Scott Searins, and in today's show, we're going to be talking about financial literacy. That's right, we're going to go over investment terms that you should know. We're going to talk about what they mean, analogies and examples to help you understand them, and then why they are important to you and your future. Now, if you haven't yet, please check us out at lifemoneyshow.com. That's lifemoneyshow.com, where you can find additional blog posts, videos, as well as other podcasts to help you build wealth, make sure you're on track for financial independence, reduce your long-term tax picture, and what you can just do to help your overall financial picture. Well, April is Financial Literacy Month, and I figured we'd cap off the month or have our last podcast of April being about financial literacy. And I thought these stats were interesting here. I pulled these from the National Today website, and we'll post a link in the show notes. Again, that's lifemoneyshow.com. But before we go into the investment terms that you need to know, I thought this was really interesting. I'm going to pull some quotes here from the site, as well as some statistics, and then we're going to dive right into those investment terms that you need to know. First off, it says it doesn't matter if you have just started learning or have been earning for a long time. Every day is a chance to reflect upon your spending and improve your overall finances. And I would say that's totally true. Every day we do something that impacts our financial picture, whether we're stopping to buy groceries, whether we're investing in our 401ks, whether we're saving, whether we're taking money out of our savings. Every day we're impacting our financial picture and our financial future. So have you stopped to think about what you're doing and how you're impacting your overall future? It says there are three components of financial literacy. There are 6 components of financial literacy, which include earning, spending, saving, investing, borrowing, and protecting. And I thought these facts were really interesting because I think, and here's the thing we talk about, or we've talked about in the past, is that, unfortunately, a lot of this isn't taught in high school. A lot of this isn't necessarily taught in college, how to be on track for our future, for our financial future, making sure that we're setting ourselves up in the right direction financially. And a few of the facts that I listed here was, in the U.S., 1 out of every 5 students lack basic skills of financial literacy. It says 29% of working women showed basic financial skills of financial literacy, where 47% of men demonstrated basic financial skills of financial literacy. Whether 29%, 47% men versus women, here's what I took away from that. That means that there is over 50% of people who are not showing basic financial literacy skills. And so, it's important that we talk about money. I know it's always kind of been this subject, hey, we don't talk about it, right? We don't talk about it maybe with other people. And that's saying, hey, we might not necessarily talk about how much we are earning or how much we have in our bank account, but we should be having conversations in regards to how do we improve our overall financial pictures. What do we need to do to make sure we're on financial track, whether that's for financial independence or retirement. And as I mentioned before, if you find value and benefit in what I'm sharing with you, help others by sharing this information, sharing the podcast, sharing our site, lifemoneyshow.com. I know a lot of times people don't want to hear it directly from another person, but listening to it, seeing it in a video, reading about it can really help. Everybody learns in a different way. And the last part here, the last statistic that I wanted to share, it said 54% of student loan holders didn't know about their future monthly payments before taking out their loans. 54% of people didn't understand the payments that they would be making before taking out their loans. This is why some people feel like they're constantly in quicksand, like they're continuously sinking and wondering how they are ever going to climb themselves out. Folks, if you are getting a loan, I really, really, really recommend, whether it's for a mortgage, whether you're borrowing money for a car, whether you're just getting a loan to do a renovation on your house, understand the payments that you got to make, but also understand the interest that you will be paying back to those that you're getting the loan from. Okay, so with that, let's dive in to some investment terms that you need to know. I'm going to talk about what they mean. I'm going to give some examples, some analogies, and we're all going to link this back just like we always do. Why is this important to you and to your future? So for each term, I'm going to start with a definition, then I'm going to go into those examples and talk about why it's important to you. Okay, so I'm going to start with stocks and bonds. Now, I realize what you might be thinking right away, that, hey, he's starting really basic. That's right, we're going to start basic, but stick with me. Please stick with me, because here's the deal. You're going to see how it all comes together for you and your financial future, and why understanding each and every one of these is so important. And the more that you understand, the more that it helps you, it helps your financial future, it helps you thrive in life, helps you going to thrive in wealth, as well as be prepared for financial independence and retirement. So here we go. Again, I'm going to start with definitions, and we're going to go into examples and analogies. Stocks. A stock, also known as an equity, is a security that represents the ownership of a fraction of a corporation. This entitles the owner of the stock to a proportion of the corporation's assets and profits equal to how much stock they own. Units of stock are called shares. So corporations issue or sell stock, right? They're selling these shares to raise funds to operate their business. Now, stocks are bought and sold predominantly on these stock exchanges. So stockholders, right? So if you're buying a share of stock, you don't actually own corporations. What you do is you are owning shares issued by the corporation. Now, owning stock gives you the right to vote in shareholder meetings, receive dividends, which are those company profits, and it gives you the right to sell your shares to somebody else. Okay, so let's just put this into real life example. We're in spring. A lot of times people are getting out, working in their yards, doing renovations on their house. So maybe, let's just say you decide to go to Home Depot or you just buy a lot of products from Home Depot. Now, this is by no means a commercial for Home Depot. You can fill in the blank with any kind of company, but I'm just trying to bring this to real life. Also, before I go too far, our compliance department loves for me to share with you that, as you know, investing involves risk, and past performance is not indicative of any sort of future results. So you're standing in line with Home Depot, you've got your cart full, you're going to you bought a shovel because you're going to be working in the yard, right? You bought some mulch, and then you said, hey, I'm going to renovate my bathroom. So now you've got some drywall on your cart and some other products so you can renovate your bathroom. And as you're standing there in line at Home Depot, you're like, gosh, wow, isn't the owner of Home Depot really lucky? Because you're looking around and you're seeing other people in line with you doing all of these same things. And you're thinking to yourself, boy, I wish I owned a part of Home Depot, because look at all these people in line, all these people that are buying products, and I'm guessing that Home Depot might be making money off of selling products to all these people. I wish I was an owner of Home Depot. Well, here's the deal. you can actually be an owner or a shareholder of Home Depot. And that's by buying stock in that company. So you can buy a share of Home Depot, right? And for example, now I'm not saying this is actually how it relates to them, just kind of an example here though. If a company has 1,000 shares of stock outstanding, so let's say Home Depot, and again, this doesn't actually relate to them, but let's say there's 1,000 shares outstanding and you decide, hey, I'm going to buy 100 shares. Well, by buying 100 shares of the 1,000 shares outstanding, that person would own and have a claim to 10% of the company's assets and earnings. Meaning when you now buy that share of Home Depot, if you decided to, right after that day, you're like, man, I want to be an owner of this. Well, if you buy that share of Home Depot, now when the company distributes its profits, you're going to get dividends, meaning they're going to distribute some of their profits to you. That's what being a stockholder is all about. You are buying ownership or you're buying shares in a company. You are being an owner of different companies by having shares in multiple stocks. So in your IRAs, your 401ks, you may individual stocks or you might have some funds. We're going to talk about that in a little bit. But by doing that, you're now an owner of companies in our as well as other economies. Now you can take this one step deeper too, right? I mentioned maybe in your shopping cart there, you've got a sheet of drywall and you look on the side of that sheet of drywall and it says USG. And you're looking around and you're like, wow, there's a lot of people renovating their houses and buying drywall. And they all say USG on the side. Well, you can actually become a shareholder in USG as well. USG is just like Home Depot, is a publicly traded company, meaning companies that you can buy shares, right? Shares of ownership in those companies. Now, does that mean Home Depot and USG are making money or the ones that you should go buy? Well, there's a lot of research that needs to go into actually which companies that you wish to purchase shares in, right? Based upon how the company's doing. Are they profitable? Are they growing? Think about this, right? Now that you understand what stock ownership is all about, it's buying ownership or shares of a company. If a company is doing well, their profits are up, well, then you're going to get dividends or portions of that profit. Also, if they're doing really, really well, right, then other people just like you who saw that, wow, look at all those people standing in line, I want to own a portion of that, then the value of your share goes up. It's more valuable because more people want your share of that company. And then that's when the dividends, profits go up. However, things can also go in the opposite direction, right? So by chance, maybe we're in a recession. People aren't spending as much on their homes. They're deciding not to do renovations. And now those lines in Home Depot don't exist. Well, then profits might be down and the value of your share could go down in ownership of the company. And that's what's going to kind of lead us into other things, talking about asset allocation and diversification. Hopefully, that just helped you understand what stock ownership is all about and understanding stocks. Now, the other part is bonds. I mentioned bonds. Now, let's start with the definition and we'll go into an example here. A bond is a fixed income instrument that represents a loan made by an investor to a borrower, typically corporate or governmental. A bond could be thought of as an IOU between the lender and borrower that includes details of the loan and its payments. Bonds are used by companies, municipalities, states, and sovereign governments to finance projects and operations. Here's one thing to know. Bonds have maturity dates, meaning bonds are for a certain term, right? And then they mature at the end of that term. Bonds have maturity dates at which point the principal amount must be paid back in full or risk default. Similarly, corporations will often borrow to grow their businesses, to buy property and equipment, to undertake profitable projects for research, development, or to hire employees. So these corporations want to borrow money, right, to do all these things I just listed. The problem is that large organizations that they run into is that they typically need far more money than the average bank will provide. So the solutions is bonds. bonds provide a solution by allowing many individual investors like you and I to then assume the role of the lender, kind of assuming that role of the bank, right? Lending these corporations or the governments or whomever it might be money, right? So you're the lender, they're the borrower. Different types of bonds. We've got corporate bonds, municipal bonds, government bonds, as well as agency bonds. So let's just give you an example. I live in the state of Illinois. Let's say the state of Illinois wants to build a new bridge. Well, one way that they can do this is they can issue a bond. And multiple people then can go purchase this bond. By purchasing the bond, you are now lending money to the state of Illinois to build their bridge. The agreement is that they will pay you back in full over that certain period of time, that length or that term, right? Maybe it's a 2-year bond or a 5-year bond. They're going to pay you back over that period of time plus regular interest. Because otherwise it'd be like, why would I lend them money if they're just going to pay me back my principal, right? But that's where the return of the bond comes in, is the interest rate that is associated with it. So they're not only going to pay you back your principal, right, the money that you're loaning them, but they're also going to pay you interest on that money that you are loaning them. Now, just from a very high level, and we're going to talk about this in a second, stocks, ownership in a company, right? You're taking ownership, now taking on that risk, right? As I had mentioned, company could do really, really well, but also there could be times where nobody's in line or that product is no longer wanted, no longer needed, and the companies could, falter as well. So you're taking a higher amount of risk to get that higher amount of return in those company profits. Actually different for bonds. You're taking on a lower amount of risk. You're just lending money for this agreement that they're going to pay you back over a set period of time for a fixed, potentially fixed interest rate. Typically those interest rates, and I'm just going to say history has shown us that the average return of stocks over a long period of time is greater than what that average return of bonds has been. Okay, so that's stocks and bonds. I told you it's all going to come full circle here. Stick with me. You're going to see how all of this relates to you and your financial future. Now we know about stocks and bonds. The next portion is asset allocation and diversification. So you say, hey, I want to be an owner in company. I want to go out, maybe buy some shares in a company. I'm going to be a stockholder. And maybe I want some less risky investments, so I'm going to also buy some bonds, right? But where, what, and do you just want to buy one company, or should you go out and buy multiple companies? What does all of that mean? So I think 2 more terms that you need to know are asset allocation and diversification. Asset allocation is an investment strategy that aims to balance risk and reward by apportioning a portfolio's assets according to an individual's goals, risk tolerance, and investment horizon. The 3 main asset classes are equities, fixed income, so stocks, bonds, and cash and equivalents. They all have different levels of risk and return, so each will behave differently over time. Like I just mentioned, sometimes stocks can do really, really well. Sometimes some stocks can do really, really poorly. You're taking on a higher amount of risk for a potential higher amount of gain over a long period of time. The fixed income or the bonds is where, yes, you still have some risk, but you're taking on a lower amount of risk, but you're also getting a potential lower amount of return over that long period of time. Now, diversification, and then I'm going to tie this all together through a really, what I feel is a good analogy here. Diversification is a risk management strategy that mixes a wide variety of investments within a portfolio. A diversified portfolio contains a mix of distinct asset types and investment vehicles in an attempt at limiting exposure to a single asset or risk. The rationale behind this technique is that a portfolio constructed of different kind of assets will, on average, yield higher long-term returns and lower the risk of any individual holding or security. Portfolio holdings can be diversified not just across asset classes, but also within the asset classes by investing in foreign markets as well as domestic markets. Okay, let's put this all together now. And we're going to use the analogy of a fruit stand. I used this a couple weeks ago. I got some great feedback on this, and I'm going to use it again, and we're going to take it one step further. Again, hearing some things over and over can really help you and your financial future. So let's say you decide you're going to start a fruit stand. Now, first decision is, are you just going to sell one fruit? Are you just going to only pick and sell oranges? Or are you going to sell multiple fruits? Now, let's think through this, right? Let's just say you decide to sell one fruit. You're going to pick oranges. And as I mentioned in that last time we talked about this, is let's say Oprah says, boy, her new favorite things are oranges, right? And whatever that is, Oprah's favorite things seems to that products kind of explode after that, right? So Oprah says, my new favorite thing is oranges. Well, your fruit stand might just do awesome, right? You are outperforming any of the other fruits that you may have picked. But let's say at the same time, you're getting oranges from Florida and there's a hurricane that wipes out your orange supplier and all of the oranges that you could potentially get from Florida. Now your business is devastated. It's going to be at least a year or 2 years before oranges are going to be coming back in Florida. And next thing you know, unfortunately, you've had to go out of business. So putting everything into one stock, again, that's where that risk and reward come in. Yes, you have a chance to overperform, but you also have a drastic chance to underperform. So the first step is, right, do you want to sell one fruit, or maybe do you want to sell multiple fruits? So you're going to instead pick oranges, apples, and bananas. So that way, if the oranges in Florida get wiped out, you still have your apples from the Northeast, and you've got your bananas from your supplier there that you're able to sell at your fruit stand. Now that's the first step in diversification, right? We're picking maybe multiple stocks, right? You're not just going with, from my example earlier, you're not just going with Home Depot. Maybe you're going with Home Depot and Lowe's, but those are all people that are like, for renovations. So you're like, okay, hey, I'm not going to just go with Home Depot. I'm going to go with Microsoft. I'm going to get totally out of this and go into some technology, right? Great. Selling multiple fruits, oranges, apples, bananas. The next step of diversification is that people might have different taste. So maybe within your apple selection, you decide you could put everything and just I'm going to do red delicious apples. But what if that's not everybody's taste? You might miss some potential consumers. So one of the decisions you might want to make is selling Granny Smith apples, Golden Delicious apples, Red Delicious apples. Hopefully you're beginning to see the importance of diversification. If you're the owner of this fruit stand, you want to continue to diversify yourself so that way you've got products to sell to different consumers. And if one product gets wiped out by some sort of event, you've got the other products in your fruit stand. Okay, let's just take this one step further, and then we're going to wrap it all up into what asset allocation and diversification is when it comes to you and your investments. Let's say your fruit stand is doing really, really, really well. Now you've come to a crossroads. You're like, boy, my fruit stand's doing awesome. I just want to continue to grow. Here's what you can do, right? You might decide, well, option A, I can open another fruit stand. High risk, right? You're taking on all of that risk. You're going to have to buy more product to open that fruit stand, but potentially high reward. You've been doing really well. You're going to get the profits from selling all those products. Or what you can do is you can lend your name, let's just say your name is, Johnny's Fruit Stand, right? You can lend that name, Johnny's Fruit Stand, to somebody else, letting them take on that risk of another fruit stand. So someone else pays you to use your name, your fruit stand. So for them, they're taking on some risk for some reward. For you, though, lower risk, lower reward. You don't have to go buy all the fruit, but you're also not going to get all of the profits. You're just lending them your name. Okay, this is how it comes all full circle, right? The same when it comes to what you need to do when investing. Asset allocation. This is, do you want to be the fruit stand owner, right? You're owning the fruit stand. You're going to buy all the products, right? Potentially higher risk for potentially higher reward. That's the stocks. Do you want to be the owner? Or do you want to be the lender? Do you just want to be that person that's going to lend the name of your fruit stand to somebody else? That's the bonds. Lower risk, but potentially lower return. So the first part is understanding in your portfolio how much is going to go into stocks, how much is going to go into bonds. Then, once you've made that decision, then you've got to start to diversify. So back to our fruit stand, do you just want to buy one stock? Do you just want to buy one fruit, which you could potentially outperform, but you also have a really good chance of underperforming? Or do you want to sell multiple fruits? Meaning, do you want to own multiple stocks in different categories? And diversification in stocks could be, do you want to have large cap companies, mid cap companies, small cap companies, international companies, developed market companies, right? And then as we talked about the apples, doing Granny Smith, Golden Delicious, Red Delicious, do you want growth companies or do you want value companies? Do you want technology companies? Do you want financial companies? Do you want energy companies? All of this can continue to get diversified more and more. So when it comes to investing, understanding asset allocation, stocks versus bonds, right? Do you want to be the owner or the lender? How much do you want of ownership? How much potentially higher amounts of return, but taking on more risk? Or how much do you want to be that lender? Lower risk for lower return. And then after you decide that, you need to make sure that your portfolio is diversified. So just like a hurricane could wipe out your cell of oranges, there's economic events that could wipe out different industries, different companies. By holding multiple companies, by having yourself diversified, it helps you reduce the overall amount of risk that you're taking to get that, on average, long-term return in comparison just to holding one overall stock. Okay, so we went stocks and bonds. Now we're understanding, hey, when it comes to stocks and bonds, asset allocation, and then diversifying ourselves. And there's different ways that we can do this through ETFs and mutual funds. Let's understand what these are. A mutual fund is a type of financial vehicle made up of a pool of money collected from many investors to invest in securities like stocks, bonds, money market instruments, and other assets. Mutual funds are operated by professional money managers who allocate the fund's assets and attempt to produce capital gains or income for the fund's investors. A mutual fund's portfolio is structured and maintained to match the investment objectives stated in its perspective. Let's go over exchange-traded funds. You might have also heard these in your IRAs, 401ks. An exchange-traded fund is a type of pooled investments security that operates much like a mutual fund. Typically, ETFs, exchange-traded fund, also ETF, will track a particular index, sector, commodity, and other asset, but unlike mutual funds, ETFs can be purchased or sold on the stock exchange the same way as a regular stock can. Folks, I'm not going to go into the difference today of exchange-traded fund versus mutual fund and which is better or which should you like. We can do that in a whole different podcast episode. But I just want you to understand what they are and the importance of them. So mutual fund or exchange-traded fund, right? What this is you are now, instead of buying an individual stock, you are buying a pool of stocks. You're buying a pool of stocks, and that fund has something that it's trying to achieve. So that fund might be trying to just purchase only energy stocks, right? So it can be a fund that's focused on energy. It might be a fund that's focused on replicating the S&P 500. It could be a fund that's focused on replicating the Dow Jones. It could be a fund that's focused on, they have out there called target date funds. It's a fund that has a mix that's focused on people specifically targeting a certain date for their retirement and then shifts around the stocks and bonds based on that date of retirement. So there are funds out there, and the funds buy pools of stocks or pools of bonds. There's bond funds as well. And you can utilize these funds in your portfolios. So if you're like, so now going back to our example, if you're like, okay, well, I want to be a stockholder, but I don't want to just buy one company. I want to make sure that I'm diversified. But boy, that would be a lot of individual stocks to go out there and buy to be diversified. Well, instead, now you can buy a fund that might own 10 stocks, might own 50 stocks. It could own hundreds of stocks. And you can utilize that fund to help diversify your overall portfolio. So earlier I was mentioning large cap companies, mid cap companies, small cap companies. Well, you can buy funds of large cap companies. You can buy funds of mid cap companies. You can buy funds of mid cap growth companies, funds of mid cap value companies. And you can utilize these funds to help diversify yourself. So one thing, now we do have some clients that from a tax perspective and where they've started and just trying to be tax efficient, we use individual stocks. But for the most part, with our clients, we utilize funds. And here's why. Let me just give you an analogy. Let's just say you're walking into a 4-story building. You got to go up to the 4th floor. And you're going to get on the elevator to do so. And let's just say where the elevators are, there's 2 elevators and it's actually a glass wall. Okay? And you look through that glass wall and the elevator on the left has 1 string holding it up. And the elevator on the right has hundreds and hundreds of strings holding it up. Which elevator are you going to get into? Most likely, like me, you're going to get into the elevator on the right. And folks, that's the difference of holding one stock or individual stocks versus holding a fund. By getting into that elevator on the right, you're utilizing funds. You've got hundreds of stocks in that fund, right? You've got, or multiple stocks in that fund. So if one string breaks, meaning if one stock does bad, you've got those other stocks that are supporting you and holding you up. That's mutual funds and ETFs. And let's bring it all full circle. The final part, what does this mean to you and your retirement? Well, most likely you've got a 401k or an IRA or a 403b or a 457 or a Roth IRA, or you've got a brokerage account or an investment account. And I hear people so often just say, well, yep, I'm okay, I've got a 401k, or yeah, I've got an IRA, or you know what, I've got this investment account. But here's where it comes all full circle to you. Understanding actually what is in that investment account, understanding what's in your 401k, what's in your IRA. Are you being an owner? Are you being a stockholder in that account? Or are you being a lender? Are you being a bondholder in that account? Because all too often, I hear, yes, I do hear this from some people. They're like, yep, I'm invested, I got a 401k. And then we take a look, and you know what? A lot of it's just sitting in cash. Or a lot of it's just way too much of it's sitting in bonds. And they're not in vehicles. They're not diversified. They're not in the right asset allocation that matches them and their future, right? Because it's not the 401k that's helping to grow your money. It's the ownership or the lendership, the ownership or the lendership that you're taking in that 401k that's going to help grow your overall funds, right? Ownership, holding the stock, or as we talked about mutual funds and ETFs, holding funds in your 401k, or if you're being a lender, holding bonds or bond funds, again, 401k, IRA, or in that investment vehicle. Because all of those terms that I just mentioned, 401k, 403b, 457, brokerage account, Roth IRA, Roth 401k, look at it this way. That is the framework to your car. That's it. It's the framework. It's a tax framework. But your car is not going to get you anywhere unless there's an engine in it. And the engine is the investments that you choose. And I really hope today helped you understand, one, when now somebody's saying, hey, do I have stocks or bonds? So when you're looking at your statements and it says, hey, you've got this much in stocks, which could also be equities, right? Stocks versus bonds. Now you know, oh, am I being an owner or am I being a lender? And then in that ownership, or if you're lending, right, what kind of diversification do you have? What different kinds of funds do you own? Are you looking at large cap companies? Are you looking at energy companies? Are you looking at mid cap companies, small cap, international? What kind of diversification do you have so that, again, if some sort of economic event, just like an event could wipe out the oranges in the fruit stand, if some sort of economic event were to hit and wipe out one part of that diversified portfolio, are you still going to have other things that may potentially perform? So stocks versus bonds, diversification, and are you purchasing individual stocks or in a lot of 401ks, a lot of IRAs, a lot of 403bs, you're going to see funds, ETFs, mutual funds. Are you purchasing funds so that way you own multiple stocks to achieve your diversification? And funds are okay too. You're just understanding that you've got a fund of stocks or you got a fund of bonds. Hope you found this very helpful. Now, the last part, right? You might be going through today and going, wow, super helpful. Love to do all this stuff on my own. And if so, I hope it brought you a lot of value and benefit. But you might also say, this is a lot. And where do I go from here? Where do I do all of my research? Where do I start? Or I just want to hire somebody to be able to do this for me. This is the last term I wanted to talk to you about. So if you are someone who is looking for a financial advisor, understanding a term that you should be asking the financial advisor. And that term is fiduciary. Now, what is a fiduciary? So if you're looking to hire a financial advisor, one key term, one key question that I feel like you should be asking them is, are they a fiduciary? A fiduciary is a person or organization that acts on behalf of another person or persons, putting their client's interest ahead of their own, with a duty to preserve good faith and trust. Being a fiduciary thus requires being bound both legally and ethically to act in the other's best interest. A fiduciary may be responsible for the general well-being of another, but often the task involves finances, managing the assets of another person or a group of people, for example. Money managers, financial advisors, and it goes through a list of folks here, corporate officers, all have a fiduciary responsibility. So, folks, if you're meeting with somebody, it's a very simple yes or no question to ask them. Are you a fiduciary? If somebody were to ask me that question, yes, I am a fiduciary. I act in a fiduciary responsibility for all of my clients. And so it's just, I thought we'd kind of wrap up with that because a lot of people do like to do this on their own, but for those that are saying, hey, I would like some help. Now I understand this. I understand what diversification is in my portfolio, understand what asset allocation means to my portfolio, understand what kinds of benefits it brings to me in my portfolio. But I don't want to go through all the research. I don't want to do this on my own. I want to turn this over to somebody else. One of the questions that you want to ask them is, are they a fiduciary? In my firm, yes, I am a fiduciary. I am legally obligated to act in all of my clients' best interest. That's what we do for our clients, and I hope this helps you in your overall process as well. Folks, thank you for joining me. I hope today brought you some knowledge. I hope it brought some value and benefit to your life. If so, subscribe on your favorite podcast player. Also, check us out at lifemoneyshow.com. Again, that's lifemoneyshow.com, where we've got videos, podcasts, blog posts, all to help you build wealth, and reduce your long-term tax picture. I look forward to our next conversation to continue to help you live life today and be financially confident about your tomorrow.
Sierens Financial Group is an independent financial services firm that utilizes a variety of investment and insurance products. Investment advisory services offered only by duly registered individuals through AE Wealth Management, LLC. AE Wealth Management and Sierens Financial Group, Inc. are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This podcast is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. Sierens Financial Group, Inc. is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein, provided by third parties, have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Sierens Financial Group, Inc.